Before the stock market crash of 1929, before the Great Depression that defined a generation, there was another economic disaster so devastating that it lasted not 1 decade, but 2. And here's the crazy part. Most people have never even heard of it. This wasn't just some regional recession. This was the world's first truly global financial crisis. It started with a single bank failure in Vienna on a Thursday morning in 1873, and within weeks it had destroyed economies on 3 continents. 23 years. That's how long this depression lasted in some countries. 23 years of deflation, unemployment, and economic chaos. And the wildest part? The mistakes that caused it are the exact same mistakes we keep making today. By the end of this story, you'll understand why every major financial crisis in history follows the same playbook, and why we never seem to learn. Let me start with something that sounds impossible. On September 18, 1873, one of the most powerful banks in America simply closed its doors, just locked them and put up a sign saying, "We're done." This wasn't some small-town bank. This was J. Cook & Company, the bank that had financed the Union Army during the Civil War, the bank that had basically saved the United States government. Abraham Lincoln himself had relied on this bank, and overnight it collapsed. Completely insolvent, bankrupt, gone. When news spread through New York City that J. Cook had failed, people thought it was a joke. It had to be a mistake. How could J. Cook fail? It would be like J.P. Morgan Chase or Bank of America suddenly closing their doors today without warning. Impossible. Except it wasn't impossible. It was real, and it was just the beginning. Within hours, panic swept through Wall Street. The New York Stock Exchange, which had never closed during a crisis before, not even during the Civil War, shut down for 10 days. 10 days. Banks across the country started failing, one after another, like dominoes falling in slow motion. Within months, over 5,000 businesses had collapsed. 5,000. And this wasn't just an American problem. This was happening simultaneously in Europe, in South America, in Australia. The entire industrialized world was imploding at the same time. So how did we get here? How did the world's economy collapse so completely, so suddenly? The answer, like most financial disasters, starts with a technology that was supposed to change everything. And that technology was the railroad. In the 1860s and 1870s, railroads were what the internet was in the 1990s, what cryptocurrency is today. They were the future. They were going to connect the world, transform commerce, make fortunes overnight. And they did all those things. But they also created the biggest speculative bubble the world had ever seen. Here's what you need to understand about railroads in this era. Building them required massive amounts of capital. We're talking about laying thousands of miles of track across wilderness, through mountains, over rivers, building bridges, tunnels, stations, buying land, hiring thousands of workers. A single railroad project could cost tens of millions of dollars, and this is in 1870s money, when the average worker made maybe $500 a year. So we're talking about projects that cost the equivalent of billions of dollars today. And where did that money come from? Banks. Specifically, banks selling bonds to investors. The pitch was simple and seductive. Invest in this railroad, and when it's completed, it'll generate massive profits from freight and passengers. You'll make your money back 10 times over, 20 times over. It's guaranteed income. Safe as government bonds, but with much better returns. Except there was a problem. Actually, there were several problems. But the biggest one was this. Nobody was asking whether all these railroads were actually needed. In the United States alone, over 33,000 miles of new track were laid between 1868 and 1873. 33,000 miles in just 5 years. That's insane. And much of this track was being built in areas that didn't have enough population or commerce to support it. There were railroads being built parallel to each other, competing for the same routes. There were railroads being built to nowhere, literally ending in empty prairie with no towns in sight. The logic was, if we build it, they will come. Build the railroad and towns will spring up around it. Commerce will follow. It's the field of dreams theory of economics, except in real life. They didn't always come. So how did we get here? How did the world's economy collapse so completely, so suddenly? The answer, like most financial disasters, starts with a technology that was supposed to change everything, and that technology was the railroad. In the 1860s and 1870s, railroads were what the internet was in the 1990s, what cryptocurrency is today. They were the future. They were going to connect the world, transform commerce, make fortunes overnight, and they did all those things. But they also created the biggest speculative bubble the world had ever seen. Here's what you need to understand about railroads in this era. Building them required massive amounts of capital. We're talking about laying thousands of miles of track across wilderness, through mountains, over rivers, building bridges, tunnels, stations, buying land, hiring thousands of workers. A single railroad project could cost tens of millions of dollars, and this is in 1870s money, when the average worker made maybe $500 a year. So we're talking about projects that cost the equivalent of billions of dollars today. And where did that money come from? Banks. Specifically, banks selling bonds to investors. The pitch was simple and seductive. Invest in this railroad, and when it's completed, it'll generate massive profits from freight and passengers. You'll make your money back 10 times over, 20 times over. It's guaranteed income. Safe as government bonds, but with much better returns. Except there was a problem. Actually, there were several problems. But the biggest one was this. Nobody was asking whether all these railroads were actually needed. In the United States alone, over 33,000 miles of new track were laid between 1868 and 1873. 33,000 miles in just 5 years. That's insane. And much of this track was being built in areas that didn't have enough population or commerce to support it. There were railroads being built parallel to each other, competing for the same routes. There were railroads being built to nowhere, literally ending in empty prairie with no towns in sight. The logic was, if we build it, they will come. Build the railroad and towns will spring up around it. Commerce will follow. It's the field of dreams theory of economics, except in real life. They didn't always come. Let me tell you about Jay Cook, because his story is crucial to understanding how this all fell apart. Cook wasn't just any banker. He was a financial genius who had revolutionized how governments raised money. During the Civil War, when the Union needed to finance the war effort, Cook developed a system of selling government bonds directly to ordinary citizens through a massive marketing campaign. He basically invented modern government bond sales, and it worked brilliantly. He raised over $3 billion for the Union war effort, an astronomical sum at the time. After the war, Cook was a national hero. He was rich, powerful, and respected, and he decided to apply his bond-selling genius to a new project, the Northern Pacific Railway. This was going to be the crown jewel of American railroads, stretching from Lake Superior all the way to Puget Sound in Washington Territory. It would open up the entire northern United States to settlement and commerce. But here's the problem. The Northern Pacific was an incredibly risky project. Most of the route went through territory that was barely explored, let alone settled. There were no towns, no farms, no businesses, just wilderness. And hostile territory at that. This was during the Indian Wars, and the government was still fighting with Native American tribes over this land. Any rational investor looking at the Northern Pacific would have said, "This is way too risky. Maybe we should wait until there's more settlement in the area." But Cook didn't see it that way. He saw unlimited potential. He convinced himself that once the railroad was built, millions of settlers would flood into the territory. Towns would spring up. The railroad would make so much money that the bonds would be the safest investment in America. So he started selling bonds. Lots of bonds. He sold them to European investors, to American banks, to insurance companies, to individual investors. He used all his marketing genius to make the Northern Pacific seem like a sure thing, and people bought them. Because Jay Cook was selling them, and Jay Cook had never failed, except the construction costs kept rising. The project kept hitting delays. The predicted settlers weren't showing up fast enough, and Cook kept selling more bonds to pay for the shortfalls, using new debt to service old debt. If this sounds familiar, it should. It's the exact same pattern as every Ponzi scheme ever created, except Cook wasn't intentionally defrauding anyone. He genuinely believed the railroad would eventually make enough money to justify everything. By September 1873, J. Cook and Company had lent out so much money to the Northern Pacific, had sold so many bonds based on future revenues that weren't materializing, that the firm's cash reserves were completely depleted. When some major bond payments came due and Cook couldn't meet them, that was it. The most trusted name in American finance was bankrupt. But here's what's fascinating. While most people were suffering, a small group of industrialists became richer than anyone in human history. These were the men who would later be called the robber barons: John D. Rockefeller, Andrew Carnegie, Cornelius Vanderbilt, J.P. Morgan. How did they get rich during a depression? Simple. They used the crisis to buy up failing companies at bargain prices, consolidate industries, and eliminate competition. When thousands of businesses are failing and desperate for cash, and you're one of the few people who has cash, you can buy everything for pennies on the dollar. John D. Rockefeller used the Depression to consolidate the oil industry. Before 1873, there were hundreds of small oil companies and refineries. By the 1880s, Rockefeller's Standard Oil controlled 90% of American oil refining. He did this by buying out competitors during the Depression when they were desperate, or by driving them out of business through ruthless price wars that he could afford, but they couldn't. Andrew Carnegie did the same thing with steel. He bought up failing steel mills, invested in new technology when his competitors couldn't afford to, and emerged from the Depression controlling a dominant share of American steel production. J.P. Morgan consolidated the railroad industry, buying up failed railroad companies and merging them into more efficient systems. The very railroads whose speculation had caused the crisis became the foundation of Morgan's fortune. This created a fundamental transformation of the American economy. Before the Long Depression, American business was characterized by lots of small companies competing with each other. After the Long Depression, it was characterized by enormous monopolies or near monopolies controlling entire industries. This was the birth of corporate America as we know it. The growing divide between the ultra-rich industrialists and struggling workers created intense social conflict. The 1870s, 1880s, and 1890s saw some of the most violent labor disputes in American history. In 1877, there was the Great Railroad Strike, which started when the Baltimore and Ohio Railroad announced a 10% wage cut, the second wage cut in 8 months. Workers walked off the job. The strike spread from Baltimore to Pittsburgh to Chicago to St. Louis. In some cities, it turned into a virtual insurrection. In Pittsburgh, workers and their supporters burned down the Pennsylvania Railroad's property, destroying over 100 locomotives and more than 2,000 rail cars. The strikes were eventually put down by federal troops. Yes, the president sent in the army to break a strike. But they marked a turning point. Workers realized that individual action was useless. They needed to organize. This period saw the rise of labor unions, from the Knights of Labor to the American Federation of Labor. But the strikes kept happening, and they kept turning violent. The Haymarket Affair in Chicago in 1886, the Homestead Strike at Carnegie's steel plant in 1892, where Pinkerton detectives hired by the company literally got into a gunfight with striking workers. The Pullman Strike in 1894, which paralyzed the nation's rail system and again required federal troops to break. These weren't just labor disputes. They were battles over what kind of country America would be. Would workers have any power to negotiate with employers, or would capital hold all the cards? Would the government protect workers or business owners? These questions defined the era. Meanwhile, there was a huge political fight brewing over what seems like a technical issue, but was actually one of the most important debates in American history. Should the United States use gold, silver, or both to back its currency? This sounds boring, but it was literally the defining political issue of the late 1800s. Here's why it mattered. The United States and most of Europe were on the gold standard, meaning the value of currency was tied to gold. But there wasn't enough gold in the world to support the expanding economy. This contributed to deflation. When the money supply grows slower than the economy, prices fall. Farmers and workers wanted the government to also use silver to back currency. There was plenty of silver being mined in the American West. Using silver would increase the money supply, which would cause inflation, which would make debts easier to pay off and potentially raise wages. Bankers and creditors obviously opposed this. They had lent out money in gold-backed dollars. They wanted to be repaid in gold-backed dollars that were worth the same or more, not in inflated silver-backed dollars that were worth less. This debate consumed American politics for decades. It led to the formation of the Populist Party. It was the central issue in the 1896 presidential election, when William Jennings Bryan gave his famous Cross of Gold speech. "You shall not crucify mankind upon a cross of gold." Bryan lost, and the gold standard remained. But the debate showed how the Long Depression had created a fundamental divide in American society between creditors and debtors, between the industrial East and the agricultural West and South, between capital and labor. The collapse of Jay Cooke and Company triggered something that had never happened before, a truly global financial panic. And this is where the story gets really interesting, because this was the first time in human history that financial markets were interconnected enough for a crisis to spread worldwide almost instantly. By 1873, the world had telegraph cables running under the Atlantic Ocean. News that used to take weeks to travel by ship now took hours. When Jay Cooke failed in New York, London knew about it the same day. Within days, European banks that had invested in American railroads started panicking. They started trying to sell off their American investments, calling in loans, hoarding cash. But here's the thing. The crisis hadn't started in America. It had started in Europe 5 months earlier, and nobody in America had paid much attention until it was too late. In May 1873, the Vienna Stock Exchange crashed. Austria-Hungary had been going through its own railroad speculation boom, and when several major projects failed, banks started collapsing. The Creditanstalt, one of the most important banks in Central Europe, nearly went under. The crash spread from Vienna to Berlin, then to other German cities. European investors, suddenly nervous about their investments, started pulling money out of risky ventures, including American railroads. This created pressure on American banks, which were already overextended from lending to railroad companies. And when Jay Cooke failed in September, it confirmed everyone's worst fears. The speculation had gone too far. The bubble was bursting. What followed was a cascade of failures that fed on itself. Banks failed because railroads couldn't pay their debts. Railroads failed because banks wouldn't lend them more money. Businesses failed because banks were calling in loans. More banks failed because businesses couldn't repay loans. It was a death spiral. By the end of 1873, 18,000 businesses had failed in the United States alone. 18,000. Unemployment shot up to 14%, which doesn't sound that bad until you realize that in the 1870s, there was no unemployment insurance, no social safety net, no welfare system. If you lost your job, you and your family simply didn't eat. But America wasn't even the worst hit. In Germany, the crash was called the Gründerkrach, the founders' crash, because it wiped out so many of the newly wealthy entrepreneurs who had gotten rich in the post-unification boom. German industrial production fell by nearly 30%. Banks across the German Empire collapsed. In Austria-Hungary, the crisis triggered a depression that lasted until the 1890s. The empire's ambitious industrialization plans ground to a halt. Unemployment soared. The government had to implement harsh austerity measures that created social unrest. Britain, despite being the world's leading industrial power, couldn't escape the contagion. British banks had lent enormous sums to American railroad companies. When those railroads defaulted, British banks took massive losses. The crisis triggered a depression in Britain that lasted from 1873 to 1896, 23 years. 23 years of stagnant wages, high unemployment, and deflation. And it wasn't just Europe and North America. The crisis spread to Australia, which had its own railroad speculation bubble. It spread to Argentina, which had borrowed heavily from European banks. It spread to every corner of the industrialized and industrializing world. This was unprecedented. There had been financial panics before, plenty of them. There had been local depressions, regional recessions, but never before had the entire world economy collapsed simultaneously. This was the first truly global economic crisis, and nobody knew how to handle it. Now here's where things get really brutal, because the Long Depression wasn't like the Great Depression of the 1930s. It wasn't a sharp crash followed by a slow recovery. It was something worse in many ways, a grinding, relentless deflation that lasted for decades. Deflation means prices are falling, and you might think, wait, falling prices are good, right? Things get cheaper. But in reality, deflation is an economic nightmare. Here's why. When prices are falling, businesses make less money. When businesses make less money, they cut wages and lay off workers. When workers have less money, they buy less stuff. When people buy less stuff, prices fall further. It's a vicious cycle that's incredibly hard to break. During the Long Depression, prices in the United States fell by about 30% over 20 years. That might not sound dramatic, but think about what it meant. If you were a farmer who borrowed money to buy land in 1873, you had to pay back that loan with dollars that were worth 30% more than when you borrowed them. Meanwhile, the price you got for your crops kept falling. Thousands of farmers went bankrupt. If you were a worker, your wages kept getting cut. And yes, things were cheaper, but you never knew if you'd have a job next month. Job security disappeared. The term tramp, meaning a homeless person who wandered from town to town looking for work, entered common usage during this period. Because there were so many unemployed men traveling the country desperately seeking any job they could find. Unemployment stayed stubbornly high throughout the period. In the U.S., it fluctuated between 8 and 14% for most of the 1870s and 1880s. In Europe, it was often worse. And remember, these numbers only counted people actively looking for work. They didn't count people who had given up, or women who wanted to work but couldn't find jobs because hiring preferences always went to men. The Long Depression also fundamentally changed global politics. As domestic markets stagnated, industrialized nations started competing more aggressively for overseas markets and colonies. If you couldn't sell your products at home because people couldn't afford them, you needed to find customers elsewhere. This period saw the height of European imperialism. The scramble for Africa, where European powers divided up almost the entire African continent among themselves, happened during the Long Depression. Britain expanded its control in India, Burma, and other parts of Asia. France built a colonial empire in Southeast Asia and Africa. Germany, newly unified, started aggressively seeking colonies. Even the United States got into the game, annexing Hawaii and, after the Spanish-American War in 1898, taking control of the Philippines, Puerto Rico, and Guam. This wasn't coincidental. The Depression created intense pressure to find new markets, new sources of raw materials, new investment opportunities. Colonies provided all three. They were captive markets where you could sell manufactured goods without competition. They provided cheap raw materials, and they offered investment opportunities for capital that couldn't find profitable uses at home. The scramble for colonies created new tensions between the great powers. Competition for empire would be one of the factors that eventually led to World War I. In a very real sense, the Long Depression helped set the stage for the catastrophic conflicts of the 20th century. But amidst all this economic suffering and social conflict, something remarkable was happening. A technological revolution that would transform human society more dramatically than perhaps any period before or since. The late 1800s saw the invention or commercialization of the telephone, the light bulb, the phonograph, motion pictures, the automobile, the airplane, the radio, the electric power grid, the elevator, the typewriter, the cash register, and dozens of other technologies that define modern life. This seems paradoxical. How could there be so much innovation during a depression? But there's actually a logic to it. During boom times, businesses can make easy money doing things the old way. During depressions, they have to innovate to survive. The companies that made it through the Long Depression were the ones that found ways to do things cheaper, faster, and better. Andrew Carnegie's steel empire was built on constantly adopting the latest technology. He was one of the first to use the Bessemer process, then quickly switched to the open hearth process when it proved superior. He invested in technology when his competitors couldn't afford to, which let him produce steel cheaper than anyone else. Thomas Edison's innovations in electric power and lighting happened during this period. Alexander Graham Bell invented the telephone in 1876, right in the middle of the Depression. The first practical automobiles appeared in the 1880s and 1890s. In a strange way, the Long Depression forced the technological innovations that would drive the economic boom of the early 20th century. It was a period of creative destruction on a massive scale. As the 1890s progressed and the Depression gradually eased, American business went through another fundamental transformation. The Great Merger Movement. Between 1895 and 1904, over 1,800 companies were consolidated into just 93 large corporations. This was when many of America's most famous corporations were formed. U.S. Steel, formed by J.P. Morgan in 1901 by merging Carnegie Steel and several other companies, became the world's first billion-dollar corporation. General Electric, DuPont, American Tobacco, National Biscuit Company, later Nabisco. All these corporate giants were formed during this period through mergers and consolidations. The logic was simple. Competition is expensive and reduces profits. Consolidation eliminates competition, allows economies of scale, and increases profits. The Depression had shown that cutthroat competition could destroy everyone. Better to cooperate, or rather, to eliminate the competition through mergers and form oligopolies or monopolies. This created enormous concentrations of economic power. A handful of men, Morgan, Rockefeller, Carnegie, and a few others, controlled vast swaths of the American economy. Morgan alone had influence over corporations representing about a quarter of America's entire industrial wealth. This eventually triggered a political backlash. The progressive era of the early 1900s was largely a response to the inequalities and monopolies created during the Long Depression. Theodore Roosevelt's trust-busting, regulations on food and drug safety, labor reforms, all of these were reactions to the excesses of the Gilded Age that emerged from the Depression. One of the lasting legacies of the Long Depression was the entrenchment of the international gold standard. During the Depression, major economies one by one committed to backing their currencies exclusively with gold. Germany adopted the gold standard in 1871. The United States effectively did so with the Coinage Act of 1873, which silver advocates called the Crime of 73, because they saw it as a conspiracy by bankers. France adopted gold in 1876. By the 1890s, almost all major economies were on gold. The gold standard created a kind of international monetary system that facilitated trade and investment across borders. If currencies were all tied to gold, then exchange rates were stable and predictable. This made international trade and finance much easier. But it also meant that governments had much less flexibility to respond to economic crises. When you're on gold standard, you can't just print more money to stimulate the economy or combat deflation. You're constrained by how much gold you have. This contributed to the length and severity of the Long Depression. The gold standard would remain in place until the Great Depression of the 1930s, when countries started abandoning it in order to fight deflation and unemployment. In fact, economic historians have found a clear correlation. The earlier a country abandoned gold during the 1930s, the faster it recovered from the Depression. The gold standard, which seemed like a source of stability, was actually a straitjacket during crises. While we focused mainly on Europe and America, the Long Depression hit Australia particularly hard, in a way that illustrates how global the crisis really was. Australia in the 1880s was experiencing a massive boom driven by wool exports, gold mining, and land speculation. Melbourne was one of the richest cities in the world. British capital poured into Australian banks and land companies. The boom seemed unstoppable. Then in the early 1890s, it all fell apart. Several of Australia's largest banks collapsed in 1893, triggering a crisis that wiped out an enormous amount of wealth. The Australian banking system essentially ceased functioning. The economy contracted by about 10% in a single year. What caused it? The same thing that caused crises everywhere else. Overlending, speculation, and interconnection with the global financial system. Australian banks had borrowed heavily from British banks and lent aggressively to local businesses and land speculators. When commodity prices fell globally, partly due to the Depression in Europe and America, Australian exports became less valuable. Banks started failing, which triggered runs on other banks, and the whole system collapsed. The Australian Depression lasted through the 1890s. Unemployment reached about 30% in some areas. Hundreds of thousands of people lost their savings. It was a catastrophe, and it happened because Australia's economy was tied to the global system. When the world economy crashed, Australia couldn't escape. Latin America also got crushed during this period, particularly Argentina. In the 1880s, Argentina was one of the fastest-growing economies in the world, attracting massive investment from European, especially British, banks. Argentina was borrowing heavily to build railroads, ports, and other infrastructure. Buenos Aires was transforming into a major cosmopolitan city. The country seemed destined to become one of the world's great powers. But Argentina's growth was built on debt and on exporting agricultural products to Europe. When the European economy crashed, demand for Argentine exports fell. The country couldn't service its debts. In 1890, Argentina defaulted on its foreign debt, triggering a crisis that nearly brought down Baring Brothers, one of Britain's most important banks. The British government had to organize a bailout of Baring Brothers, an early example of too big to fail. But Argentina itself went through a devastating crisis. The peso collapsed, banks failed. The economy contracted sharply. Political instability followed, with multiple coups and governments rising and falling. The pattern was the same as everywhere else: easy credit, overlending, speculation, overbuilding, commodity price crashes, debt defaults, banking failures, depression. The Long Depression wasn't just a Western phenomenon. It was truly global, affecting every corner of the world economy. The Long Depression fundamentally changed society in ways that went far beyond economics. This was the period when modern ideologies and social movements emerged in response to industrial capitalism's failures. The labor movement, as we discussed, grew enormously during this period, but so did socialism. Karl Marx's ideas, which had seemed radical and theoretical, started gaining real traction among workers who saw the system crushing them. Socialist parties formed across Europe. Even in America, socialist candidates started winning local elections in some cities. Anarchism also grew during this period, particularly in Europe. Some anarchists turned to violence, assassinating several heads of state in the 1890s and early 1900s. The President of France in 1894, the Prime Minister of Spain in 1897, the Empress of Austria in 1898, the King of Italy in 1900, and President William McKinley of the United States in 1901. The Depression also changed attitudes toward immigration. In good times, immigrants were welcome, cheap labor for expanding industries. During the Depression, they became scapegoats. The Chinese Exclusion Act in the United States in 1882 was partly a response to anti-immigrant sentiment driven by economic anxiety. Similar anti-immigrant movements emerged across Europe. Women's rights movements also grew during this period, partly because the economic crisis forced more women into the workforce and made the contradiction between their economic role and their lack of political rights more obvious. The Long Depression created the social and ideological conflicts that would define the 20th century. Labor versus capital, socialism versus capitalism, nationalism versus internationalism, immigration versus nativism. The Depression finally began to ease in the mid to late 1890s. Several factors contributed to the recovery. First, the discovery of new gold deposits in South Africa, Australia, and Alaska increased the global gold supply. This helped ease the deflation that had characterized the Depression. Prices started rising again, which encouraged investment and spending. Second, new technologies that had been developed during the Depression started being widely adopted, increasing productivity. Electric power, in particular, transformed manufacturing. The internal combustion engine started replacing horses. Steel production became cheaper and more efficient. Third, consolidation had eliminated a lot of the destructive competition that had driven down prices and profits. The new monopolies and oligopolies were profitable in ways that the fragmented industries of the 1870s hadn't been. Fourth, governments had learned some lessons, not all the right lessons, but some lessons, about managing financial crises. Central banks started playing a more active role. The Bank of England, for instance, became more sophisticated in managing currency crises. By 1896 or 1897, depending on the country, the worst was clearly over. Economic growth resumed, unemployment fell, prices stabilized and then started rising. The world entered what would later be called the Belle Époque in Europe, or the Progressive Era in America, a period of relative prosperity and optimism that would last until World War I shattered it. So why do we remember the Great Depression of the 1930s but not the Long Depression of the 1870s, 1890s? Partly it's because the Great Depression was more dramatic, a sharp crash followed by high-profile government interventions like FDR's New Deal. Partly it's because the Great Depression was followed immediately by World War II, which fixed it firmly in historical memory. But the Long Depression might actually have been more economically significant. It lasted much longer. It transformed the global economy more fundamentally. It created the corporate capitalism, the labor movements, the social conflicts, and the imperial competition that defined the 20th century. Yet we've largely forgotten it. And that forgetting has consequences, because the Long Depression teaches crucial lessons about financial crises that we keep needing to relearn. Lesson 1. Speculation based on future potential rather than current reality creates unsustainable bubbles. The railroad boom of the 1860s and early 1870s was based on the assumption that settlement and commerce would materialize to justify the investment. Often it didn't. Sound familiar? It's the same logic as the dot-com bubble or the housing bubble. Lesson 2. When financial systems become globally interconnected, local crises can become global catastrophes. The Vienna stock crash, the J. Cook failure, the Australian banking crisis. Each could have been contained if the systems weren't so interlinked. But they were, so the crisis spread everywhere. Lesson 3. Deflation is as dangerous as inflation, maybe more so. The Long Depression showed what happens when prices fall for years on end. Debts become unpayable. Businesses fail. Unemployment rises. It's a trap that's very hard to escape. Lesson 4. Inequality creates social instability. The rise of the robber barons while workers suffered created intense conflict that took decades to resolve and shaped political developments for generations. Lesson 5. Financial crises don't end quickly. The Long Depression lasted 2 decades in some places. The idea that crises can be quickly resolved with the right policies is often wrong. Sometimes the structural adjustments take a very long time. When you understand the Long Depression, the 2008 financial crisis starts looking very familiar. You had overlending, subprime mortgages instead of railroad bonds, but the principle was the same. You had speculation based on the assumption that asset prices, housing, would keep rising forever. You had a globally interconnected financial system where a crisis in American mortgage markets immediately spread worldwide. You had major financial institutions failing, Lehman Brothers instead of J. Cook and Company, but the effect was the same panic. You had governments intervening with bailouts, just like the British government bailed out Baring Brothers in 1890. And you had a long, grinding recovery where unemployment stayed high for years, where people lost their homes, and savings, where inequality increased as the wealthy bought assets at depressed prices while ordinary people struggled. The 2008 crisis could easily have turned into another Long Depression. The fact that it didn't, that recovery came within a few years rather than 2 decades, was largely due to lessons learned from the Great Depression of the 1930s. Central banks aggressively cut interest rates and created money to fight deflation. Governments ran large deficits to support demand. The response wasn't perfect, and many people suffered tremendously, but it prevented the kind of multi-decade depression that happened in the 1870s, 1890s. But here's the troubling question. Have we really learned the lessons? Or have we just learned how to postpone the reckoning? The massive money creation and deficit spending since 2008 have prevented depression, but they've also created new problems. Asset bubbles, increased debt, rising inequality. Are we setting up the next crisis even as we congratulate ourselves for avoiding the last one? Let me tell you one more story that captures the whole era. In the 1880s, there was a railroad called the Oregon and California Railroad that was building a line from Portland south through Oregon. The company received land grants from the government, basically free land alongside the railroad route that it could sell to finance construction. The railroad sold bonds based on the projected value of this land and the future profits from railroad operations. Investors in Boston and New York bought these bonds, believing they were investing in America's future. But the land turned out to be mostly worthless timberland in remote areas. The towns that were supposed to spring up along the route didn't materialize. The railroad never made money. By the 1890s, it was bankrupt. The bondholders lost everything. Decades later, during the New Deal, the federal government reclaimed the land grants. Because the railroad had violated the terms by not selling the land to settlers at reasonable prices as required. That land eventually became part of the revested Oregon and California Railroad grant lands. public lands managed by the Bureau of Land Management. So in the end, the investors lost their money, the railroad failed, and the land went back to the government. The whole thing had been pointless from an investment standpoint. Just a transfer of wealth from Eastern investors to railroad promoters who got rich on construction contracts and stock manipulation. And this story could be told hundreds of times over. Railroads that never should have been built, that bankrupted their investors, that accomplished nothing except enriching promoters and leaving scars on the landscape. But here's the interesting part. Some of that infrastructure, even the uneconomic parts, eventually became useful. Those railroad lines, even the ones that failed financially, opened up territory. They made later development possible, the technology and engineering experience. But here's the interesting part. Some of that infrastructure, even the uneconomic parts, eventually became useful. Those railroad lines, even the ones that failed financially, opened up territory. They made later development possible. The technology and engineering experience gained from building them was valuable. The telegraph lines that ran alongside the tracks created communication networks. So you have this paradox. The investment was economically disastrous for the investors, caused a global depression, ruined millions of lives. But it also built infrastructure that had long-term value. The railroad boom was simultaneously a catastrophic mistake and a necessary step in development. How do you reconcile that? You can't, really. It's just the brutal reality of how progress sometimes happens, through waste, suffering, failure, and crisis. The question is, whether there was a better way. Could we have built the railroads more gradually, more rationally, without the speculation and the crashes? Probably. But that's not how it happened. One lasting consequence of the Long Depression was the transformation of how finance worked. Before the 1870s, banking and investment were relatively localized. After the crisis, financial power became concentrated in a few major centers: New York, London, Paris, Berlin. J.P. Morgan emerged from the Long Depression as the most powerful financier in the world. His bank didn't just lend money, it reorganized entire industries. When railroads went bankrupt, Morgan would take them over, restructure them, consolidate them with other railroads, and refinance them. He did the same with steel companies, manufacturing companies, shipping companies. This was the birth of modern investment banking. Morgan wasn't just a lender, he was effectively a corporate strategist who used financial power to reshape American business. Other banks followed his model. The House of Rothschild in Europe played a similar role. This concentration of financial power had profound implications. It meant that a small number of men controlled access to capital for entire industries. If Morgan decided your company shouldn't get financing, you were probably doomed. If he decided to back you, you could become enormously successful. Critics called this the money trust, a conspiracy of powerful bankers controlling the economy. And while it wasn't exactly a conspiracy, these men often competed with each other. It was true that financial power had become concentrated to an unprecedented degree. This eventually led to reforms. The Federal Reserve System, created in 1913, was partly a response to concerns about the concentration of financial power in private hands. The idea was to create a public institution that could provide the stabilizing functions that J.P. Morgan had personally provided during the Panic of 1907, when Morgan essentially bailed out the entire American financial system out of his own pocket. The Long Depression also established patterns in international finance that lasted until World War I, and in some ways that we still live with today. The gold standard created a system where international debts and trade imbalances had to be settled in gold. Countries that ran trade deficits, imported more than they exported, would lose gold. Countries with trade surpluses would accumulate gold. This was supposed to be self-correcting. Countries losing gold would experience deflation, making their exports cheaper and imports more expensive, which would eventually balance trade. Countries accumulating gold would experience inflation with the opposite effect. But this adjustment process was brutal. It required deflation in deficit countries, falling prices, falling wages, unemployment, and it could take years or decades to work. The Long Depression showed just how painful this adjustment could be. Britain, as the world's largest economy and the center of the global financial system, played a crucial role in managing this system. The Bank of England became essentially the world's central bank, using its gold reserves and interest rate policies to stabilize the global system. When crises hit, British banks would often provide emergency lending to prevent total collapse. This system worked reasonably well from the 1890s to 1914, creating a period of relative financial stability and economic growth. The first age of globalization. International trade boomed. Capital flowed freely across borders. You could travel from London to Hong Kong without a passport. It seemed like a new era of peace and prosperity. But the system's weakness was that it depended on Britain remaining dominant and on countries being willing to accept the painful adjustments the gold standard required. World War I shattered British dominance and made countries unwilling to sacrifice domestic concerns for international monetary stability. The gold standard was suspended during the war, briefly restored in the 1920s, then collapsed permanently during the Great Depression. The Long Depression also transformed economics as a field of study. Before the 1870s, classical economics, the theories of Adam Smith and David Ricardo, dominated thinking. These theories assumed that markets would naturally reach equilibrium, that economic crises were temporary disruptions that would self-correct. The Long Depression showed that crises could last for decades, and that market forces alone might not solve them. This led to new schools of economic thought. In America, economists started studying monopolies and arguing that markets didn't always work efficiently. This institutional economics influenced progressive-era reforms and antitrust laws. In Europe, marginal utility theory and the beginnings of neoclassical economics emerged, trying to make economics more mathematical and scientific. Socialist economics gained credibility because classical economics clearly couldn't explain or prevent the Long Depression. If capitalism led to decades of unemployment and suffering, maybe socialism was worth considering. The Depression also led to new thinking about monetary policy. Economists started understanding that the money supply mattered, that deflation was dangerous, that the gold standard might be a constraint rather than a benefit. These insights wouldn't be fully developed until John Maynard Keynes and others in the 1930s. But the foundations were laid during the Long Depression. Basically, the Long Depression forced economists to confront the fact that their theories didn't match reality. Markets didn't self-correct quickly. Deflation didn't lead to rapid adjustments. Unemployment could persist for decades. This intellectual crisis in economics set the stage for 20th century economic thought. Behind all these big historical forces were millions of individual human stories. Let me tell you about just a few to make this real. There was a farmer in Kansas named William Allen White who watched his father's farm fail during the Depression. His father had borrowed money to expand during good times, then couldn't repay when crop prices collapsed. They lost everything. Young William eventually became a famous journalist and editor, and his experiences during the Depression shaped his progressive politics for life. There was a steel worker in Pennsylvania named John McLucky who worked at Carnegie's Homestead plant. During the Depression, his wages were cut repeatedly while he watched Carnegie become one of the richest men in the world. McLucky became a union leader and helped organize the Homestead strike in 1892. After the strike was broken, he was blacklisted from the steel industry. He had to flee Pennsylvania, eventually ending up in Mexico, where he lived in poverty for the rest of his life. His crime? Trying to negotiate better wages. There was an investor in London named Edward Speyer who had put most of his family's money into American railroad bonds. When the railroads defaulted, he lost almost everything. He spent the last 20 years of his life in genteel poverty, living off the charity of relatives, bitter about how he'd been ruined by investments that were supposed to be safe. There was a young economist named Thorstein Veblen who came of age during the Depression. His academic career was shaped by trying to understand how an economy could produce so much wealth, yet leave so many people in poverty. He coined the term conspicuous consumption to describe how the rich spent money to display status. His work influenced generations of economists and sociologists. There was a labor organizer named Mary Harris Mother Jones who lost her husband and 4 children to yellow fever in 1867, then lost her business in the Chicago fire of 1871. During the Depression, she became involved in the labor movement, traveling the country to support strikes and organize workers. She lived to be nearly 100, spending 6 decades fighting for workers' rights, a fight that began during the Long Depression. These were real people whose lives were shaped by forces they didn't understand and couldn't control. Economic policies made by bankers and politicians in distant capitals determined whether they could feed their families. That's the human reality behind the statistics and the historical analysis. The Long Depression didn't just transform economics, it transformed politics. In America, it led to the populist movement and the progressive era. The populists, representing farmers and workers who had been crushed by the Depression, demanded reforms: regulation of railroads and banks, antitrust laws, graduated income tax, direct election of senators, an 8-hour workday. Most of these seemed radical in the 1890s. By the 1910s, many had been enacted. The Depression had shifted the political center, making reforms that once seemed impossible become necessary. In Europe, the political consequences were even more dramatic. Socialist and labor parties grew from fringe movements to major political forces. In Germany, the Social Democratic Party became the largest party by 1912. In Britain, the Labour Party emerged as a major force. Even in countries where socialists didn't win power, they forced the establishment to make concessions: social insurance, factory regulations, limits on working hours. The Depression also contributed to nationalism and imperialism. When domestic economies stagnated, countries looked outward for solutions, seeking colonies, protected markets, spheres of influence. The competition for empire that intensified during the 1880s and 1890s was partly driven by economic desperation. Some historians argue that the Long Depression helped create the tensions that led to World War I. The scramble for colonies created conflicts. The rise of nationalism created hostilities. The economic anxiety created social instability. The war didn't cause the Depression, but the Depression helped create the world that produced the war. One crucial lesson from the Long Depression was about scale and size. The companies that survived and thrived were the ones that got big enough to weather the storm. Small businesses, small banks, small railroads, they got wiped out by the thousands. They didn't have the resources to survive years of deflation and stagnant demand. But large corporations with diversified operations, access to capital, and economies of scale could cut costs, buy up failing competitors, and eventually emerge stronger. This is why the Depression led to the age of big business. It wasn't just that monopolies were formed, it was that the economic environment favored large organizations over small ones. A giant corporation could lose money for years if necessary, buying market share and waiting for conditions to improve. A small business would go bankrupt in months. This pattern has repeated in every subsequent crisis. The 2008 financial crisis. Small banks failed by the hundreds while the too-big-to-fail banks got bailouts. The COVID pandemic. Small businesses closed while Amazon and Walmart thrived. Crises don't just redistribute wealth, they redistribute it toward those who are already big and powerful. The Long Depression taught capitalists that size was survival. Get big or die. This logic has dominated business strategy ever since. Every company wants to be big enough that it can survive crises that would kill smaller competitors. Every company wants to be too big to fail. Despite the economic disaster, the Long Depression era left behind a remarkable infrastructure legacy. The railroads that caused the crisis, even the ones that failed financially, connected the country in ways that enabled later development. By 1900, the United States had more railroad mileage than all of Europe combined. This network made possible the industrial economy of the 20th century. It allowed for national markets where goods could be shipped efficiently. It opened up the West to settlement. It connected resources to factories to consumers. The same was true in other countries. Russia built the Trans-Siberian Railway during this period, a massive project that opened up Siberia. Argentina built a railroad network that made it one of the world's leading agricultural exporters. India's railroad network, built by the British, transformed the subcontinent's economy. Was all this railroad building economically rational? No. A lot of it was wasteful, built too early, built in the wrong places. But once it existed, it became valuable. Infrastructure has this quality. Its value isn't always apparent when it's built. It becomes valuable when other things develop around it. This is true of canals in the early 1800s, railroads in the late 1800s, highways in the mid-1900s, and internet infrastructure today. There's overbuilding, speculation, waste, then crisis. Then eventually, the infrastructure becomes the foundation for the next phase of growth. Understanding this pattern helps us think about current infrastructure debates. Should we build high-speed rail? Invest in 5G networks? Build out renewable energy grids? The economic case might be weak in the short term, but in the long term, infrastructure enables possibilities we can't always predict. Let's go deeper into why the long depression lasted so long. The key was deflation, falling prices that persisted for decades. And once deflation starts, it's incredibly hard to stop. Here's how the trap works. Prices are falling, so consumers wait to buy things because they'll be cheaper later. Because consumers aren't buying, businesses can't sell products. Because they can't sell products, businesses cut production and lay off workers. Unemployed workers have less money, so they buy even less. This pushes prices down further. The cycle continues. Meanwhile, anyone who borrowed money is in trouble. If you borrowed $1,000 when wheat was selling for $1 per bushel, you plan to sell 1,000 bushels to repay the loan. But if wheat falls to 70 cents per bushel, you now need to sell 1,429 bushels to repay that same loan. The real value of debt is increasing, crushing borrowers. This is what economists call a deflationary spiral, and it's one of the most dangerous economic conditions. The Long Depression showed just how long such a spiral can persist. From the mid-1870s to the mid-1890s, 20 years, prices kept falling in most countries. 20 years of wages being cut, of farms being foreclosed, of businesses failing. The only thing that broke the cycle was the discovery of new gold deposits in the 1890s, which increased the money supply and finally stopped the deflation. But it took 20 years. 20 years of suffering that could have been shortened if governments had understood monetary policy better. This experience influenced economic thinking for decades. It's why central banks today are so focused on preventing deflation. It's why during the 2008 crisis, the Federal Reserve and other central banks created trillions of dollars of new money. They were terrified of repeating the Long Depression's deflationary trap. They'd learned that lesson at least. The Long Depression was also a massive inequality-generating machine. Wealth concentrated at the top to a degree not seen before in American history. By 1890, the richest 1% of Americans owned about a quarter of all wealth in the country. By 1900, it was closer to a third. This level of inequality wouldn't be matched again until the 2000s. How did this happen? Several mechanisms. First, deflation helped creditors and hurt debtors. If you had money saved or lent out, deflation made you richer in real terms. If you had debts, deflation crushed you. Since the wealthy were more likely to be creditors and the poor were more likely to be debtors, wealth flowed upward. Second, as we discussed, those with capital during the Depression could buy assets at fire sale prices. Rockefeller and Carnegie didn't just get lucky. They used the Depression strategically to buy out competitors and consolidate industries. Third, the gold standard and deflation kept real interest rates high, meaning lenders earned good returns even as the economy stagnated. If you had capital to lend, you could get rich just collecting interest while everyone else struggled. Fourth, workers had no bargaining power during a depression with high unemployment. Wages got cut repeatedly. Working conditions deteriorated. The balance of power between capital and labor shifted dramatically toward capital. The result was the Gilded Age, a period of ostentatious wealth for a tiny elite while masses of workers lived in poverty. The mansions in Newport, Rhode Island, the palatial estates, the lavish parties where millionaires smoked cigars rolled in $100 bills. This wasn't just tasteless. It was the visible manifestation of an economy that channeled wealth upward. This level of inequality was politically unstable, which is why the Progressive Era brought reforms. But it took decades of conflict, strikes, protests, political movements to force those reforms. The Long Depression created an inequality crisis that took a generation to even partially resolve. So why has the Long Depression been largely forgotten? Why do high school students learn about the Great Depression but not the crisis that preceded it by 50 years and lasted much longer? Part of it is that the Long Depression was gradual. There was no single dramatic crash like 1929's Black Tuesday. The Panic of 1873 was dramatic, sure, but the depression that followed was a slow, grinding deflation rather than a sharp collapse. Gradual disasters don't stick in memory the way sudden ones do. Part of it is that the long depression ended without a dramatic resolution. There was no New Deal, no clear moment when things turned around. The depression just gradually faded as new gold supplies eased deflation and new technologies created opportunities. This doesn't make for a compelling narrative the way FDR's first 100 days does. Part of it is that World War I and the Great Depression overshadowed earlier history. By the 1930s, the 1870s seemed like ancient history. The veterans of the Civil War were dying. The robber barons were passing away. A new generation had new crises to deal with. And part of it is that the long depression didn't fit neatly into how Americans wanted to remember their past. The late 1800s were the period when America became an industrial superpower, when the frontier closed, when the nation took its place on the world stage. That's a triumphant narrative. The long depression, with its suffering, inequality, and conflict, complicates that story. But forgetting it has costs. The long depression teaches lessons about financial crises, inequality, deflation, and the dangers of speculation that are directly relevant today. By forgetting it, we lose access to those lessons and risk repeating the mistakes. When you study the long depression, you can't help but see parallels to our current era. We have massive speculation in certain assets, tech stocks, cryptocurrencies, real estate in some markets. We have record levels of debt, government debt, corporate debt, household debt. We have extreme inequality, with wealth concentrated at the top to degrees not seen since the Gilded Age. We have a globalized financial system where crises can spread worldwide in hours. We have industries dominated by a handful of giant corporations. We have political polarization driven partly by economic anxiety. We have workers feeling left behind by economic changes while the wealthy get richer. Does this mean we're heading for another long depression? Not necessarily. We've learned some lessons. Central banks understand monetary policy better. We have social safety nets that didn't exist in the 1870s. We have international institutions designed to coordinate responses to crises, but we've also created new vulnerabilities. The financial system is more complex and interconnected than ever. Debt levels are higher. Political systems seem less capable of coordinating effective responses. And we face challenges the 1870s didn't. Climate change, technological disruption, geopolitical tensions. The question is whether we've learned enough from past crises to prevent future ones, or whether each generation has to learn these lessons anew through painful experience. History suggests the latter. Every generation thinks this time is different, that old rules don't apply, that we're smarter than our ancestors. And every generation eventually learns, usually the hard way, that the fundamentals haven't changed. If there's any optimistic note to end on, it's that societies can emerge from even prolonged crises. The long depression didn't last forever. Eventually new technologies, new gold supplies, and structural adjustments brought recovery. The early 20th century before World War I was actually a period of broadly shared prosperity in much of the Western world. More than that, the long depression led to reforms that made capitalism work better. Antitrust laws broke up some of the worst monopolies. Labor laws gave workers more rights and protections. Progressive taxation reduced inequality somewhat. Regulations on banking and finance made the system somewhat more stable. These reforms didn't happen automatically. They came from decades of political struggle. They came from labor unions organizing and striking despite violent opposition. They came from populist politicians challenging the establishment. They came from muckraking journalists exposing corporate abuses. They came from reform-minded politicians willing to take on powerful interests. The Long Depression showed that markets alone don't solve every problem. Sometimes you need government intervention, regulation, redistribution. The Progressive era reforms were a response to the failures the Long Depression revealed. They weren't perfect. Many problems remained, and some reforms failed or backfired. But they represented society learning from the crisis and trying to build something better. That's the pattern. Crisis reveals flaws in the system. Suffering motivates people to demand change. Eventually, If the political system is responsive enough, reforms happen. The system improves, at least somewhat. Then new problems emerge, leading to new crises, leading to new reforms. It's not a straight line of progress, but it's not hopeless either. If there's one ultimate lesson from the Long Depression, it's this. Financial crises are not random acts of fate. They follow patterns. They're caused by specific behaviors, overlending, speculation, ignoring risk, believing this time is different, prioritizing short-term gains over long-term stability. The Long Depression was caused by railroad speculation that ignored economic fundamentals. The Great Depression was caused by stock market speculation that ignored valuations. The 2008 crisis was caused by real estate speculation that ignored whether borrowers could actually repay loans. The patterns repeat, and the solutions follow patterns too. Stop the panic by providing liquidity, prevent deflation by managing the money supply, reform the financial system to reduce future speculation, provide support to those suffering from the crisis, reduce inequality to create a more stable society. We know what causes crises. We know how to prevent them. We know how to respond to them. And yet we keep having them. Why? Because the incentives are wrong. People who take excessive risks during booms often get rich, at least temporarily. By the time the crisis hits, they've already cashed out. The people who suffer are usually not the people who caused the problem. So there's no accountability, no feedback loop that would prevent future crises. And because humans have short memories, each generation thinks it's smarter than the last, that the old rules don't apply to them. We forget that every boom ends in a bust. We forget that what goes up must come down. We forget that trees don't grow to the sky. The Long Depression happened because people forgot the lessons of previous financial crises. The Great Depression happened partly because people had forgotten the Long Depression. The 2008 crisis happened partly because people had forgotten the Great Depression. And the next crisis will happen partly because we're forgetting 2008. So consider this a warning. Right now, in our current moment, there are probably bubbles building. There are probably risks being ignored. There are probably people making the same mistakes that led to the Long Depression and the Great Depression and the 2008 crisis. Maybe it's in cryptocurrency, where values seem disconnected from any underlying reality. Maybe it's in tech stocks trading at stratospheric valuations. Maybe it's in corporate debt, where companies have borrowed enormous sums at low interest rates. Maybe it's in government debt, which has exploded to levels never seen in peacetime. Maybe it's in all of these things at once. We won't know until the crisis hits. That's how it always works. During the boom, people dismiss the warnings. They point to all the reasons why this time really is different. The skeptics are told they don't understand the new paradigm, that they're stuck in the past, that they're missing out on easy money. Then the crisis hits, and suddenly everyone says they saw it coming. Except most didn't, or if they did, they didn't act on it. Because fighting the trend, being cautious when everyone else is euphoric, sitting out the boom, these things are hard. They require discipline and conviction and a willingness to be wrong or early, which in finance amounts to the same thing. The Long Depression, forgotten as it is, offers a warning across the centuries. It says booms built on debt and speculation always end badly. It says, when everyone tells you that the old rules don't apply, they probably do. It says, inequality and instability go together. It says, crises hurt ordinary people far more than they hurt the people who cause them. And so the cycle continues. Boom and bust, euphoria and panic, speculation and crisis, reform and regression. We learn lessons, then forget them. We build systems to prevent disasters, then slowly dismantle them when memories fade. We regulate finance after crises, then deregulate when things seem stable. The Long Depression was followed by the Progressive Era. The Great Depression was followed by the New Deal and decades of financial regulation. The 2008 crisis was followed by Dodd-Frank and other reforms. But already, some of those regulations are being rolled back. Already memories of 2008 are fading. Already new speculation is building. Is this cycle inevitable? Is it just human nature, endlessly repeated? Or could we actually learn from history and break the pattern? Honestly, history doesn't give much reason for optimism. Every generation thinks it's learned from the past. Every generation thinks it's immune to the mistakes of previous eras. And every generation eventually faces its own crisis, learns its own painful lessons, implements its own reforms, which the next generation will then forget or dismantle. But maybe that's okay. Maybe the cycle of boom and bust, crisis and reform, is just part of how capitalism works. Maybe creative destruction, for all its pain, is how progress happens. Maybe we can't have the innovation and growth without also having the speculation and the crashes. Or maybe that's just an excuse for not doing better. Maybe we could have more stable growth with less inequality and fewer catastrophic crises if we actually learned from history instead of repeating it. Maybe the Long Depression, and every crisis since, didn't have to be as bad as they were. The Long Depression started with a bank failure in 1873 and lasted until the mid-1890s. 20-plus years of deflation, unemployment, and economic stagnation. Millions of lives disrupted, fortunes lost, families destroyed, political systems stressed, societies transformed, and most people today have never even heard of it. That should terrify you. Because if we can forget a crisis that lasted 2 decades and transformed the world, what else have we forgotten? What other lessons are lost to history because they don't fit our preferred narratives? The Long Depression teaches us that crises can last much longer than we think possible, that deflation is as dangerous as inflation, that inequality creates instability, that speculation based on future potential rather than present reality creates bubbles, that globalized financial systems spread contagion, that markets don't always self-correct, that size and concentration of power increase during crises. These lessons are as relevant today as they were in 1873. The technologies change. The specific assets being speculated on change. The names of the banks and companies change, but the fundamental dynamics remain the same. So pay attention. Watch for speculation disconnected from fundamentals. Watch for overlending and excessive debt. Watch for everyone saying, "This time is different." Watch for euphoria and fear of missing out driving investment decisions. Watch for inequality reaching extremes. Watch for warnings being dismissed. Because somewhere, right now, the seeds of the next crisis are being planted. And when it hits, people will say, "Nobody could have seen this coming," even though the patterns are visible for anyone who studies history. The Long Depression isn't just history. It's a warning from the past about mistakes we're probably making right now. Whether we listen to that warning or ignore it, that's up to us. But history suggests we'll probably ignore it until it's too late, and the cycle will continue.